Are you aware that over 70% of small businesses in the United States operate as LLCs or S-Corps? Choosing the right one could save you thousands in taxes each year. In today's video, we're diving deep into the world of LLCs and S-Corps, breaking down everything you need to know to make the best decision for your business. Don't forget to hit the like button, subscribe for more insightful content, and drop any questions you have in the comments below. Let's get started. Number 1 is limited liability protection. This is the shield part. If your business owes money or faces legal issues, your personal assets, like your home and savings, are usually protected. Number 2, management flexibility. You get to decide how you want to manage the business, which can be really simple or more structured. Number 3, benefit is pass-through taxation. Instead of the business paying taxes, any money the business makes passes through to you, and you pay taxes on it as part of your personal income. This can lead to some tax savings. Choosing an LLC is smart because it offers protection and freedom. It's like having a strong, flexible tree that can bend with the wind without breaking, keeping everything safe and secure underneath. It is also the simplest type of entity to form. But it's not all smooth sailing. One big disadvantage is paying those self-employment taxes. Self-employment taxes are up to 15.3% of your net taxable income. Here is an example of an LLC. Imagine someone who starts a small online store selling handmade crafts. They choose to make their business an LLC. This way, if the business ever has debt or legal problems, their personal assets, like their home and savings, life insurance, 401k, etc., are safe. Plus, they enjoy the freedom to run the business their way and benefit from simpler taxes. But they also have to be ready to handle self-employment taxes on their earnings. This decision helps them sleep better at night, knowing their personal stuff is safe from business troubles. Moving on to the next entity classification, which is S-corporations. An S-Corp or an S-corporation is a pass-through entity, which means the S-Corp itself never pays any taxes, but the taxes eventually flow to the owners or its shareholders. In other words, the S-Corp return is an informational tax return that gets its shareholders/owners a form known as Schedule K-1, which then gets attached to their personal return form 1040. So what are its tax advantages? The big win here is that S-Corps don't pay taxes on their earnings directly. The owners do, which can save money on taxes. There are, however, shareholder restrictions. S-Corp can have not more than 100 shareholders/owners. They all need to be people, not other companies, and no foreigners allowed. How do owners in an S-Corp get paid? Owners get paid in 2 ways, a regular salary and extra payments called distributions. However, there is a difference on how regular salary and distributions get taxed. On salary, the owner pays something known as payroll taxes, and on distributions, he might or might now pay any tax, which depends on his basis that he has within the S-Corp. So, what is a shareholder basis? Each shareholder has a basis in the S-corporation, which is initially the amount they invested in the company. This basis is increased by the income attributed to them and decreased by any losses, deductions, and distributions. When are distributions non-taxable? Distributions are typically not taxable to the shareholder as long as they do not exceed the shareholder's stock basis in the S-corporation. Essentially, shareholders can receive distributions tax-free up to the amount of their basis. So when do distributions become taxable then? If a shareholder receives distributions in excess of their stock basis, the excess is taxed as a capital gain. This is reported on the shareholder's personal tax return and is subject to capital gains tax rates, taxed up to just 20%, which is still less than paying the normal income tax, which could be as high as up to 39%, or paying self-employment taxes, which are 15.3%. Let us now do a comparison between LLCs and S-Corps. When it comes to LLCs and S-Corps, think of them as 2 different tools in your toolbox, each with its own use for building your business dream. In terms of tax implications, with an LLC, the money the business makes goes directly to the owners, who then pay personal income taxes on it. This can be simpler, but watch out for self-employment taxes that are up to 15.3%, which can be a bit high. S-Corps have a neat trick. They let owners split their money into salary and dividends, potentially lowering the overall tax bill since dividends are taxed less. However, the IRS watches closely to make sure the salary is fair, so no funny business. In terms of ownership and investor appeal, LLCs are pretty easy to start, and you can have as many or as few members as you like from anywhere. This makes it flexible, but can be less attractive to big investors who might see it as too informal. S-Corps are more formally structured, though. There's a limit on the number of owners, 100 max, and they all have to be U.S. citizens or residents. This can make things more complicated, but might give your business a more polished look to investors. In terms of operational requirements and compliance, LLCs are low maintenance in the business world. Less paperwork, fewer rules, more freedom to run things your way. S-Corps, on the other hand, are like having a garden that needs regular tending. There's more paperwork, and you have to follow stricter rules, but it can bear fruit in the form of tax savings and credibility. Here is an example. Sarah runs a successful online store as an LLC, enjoying the simplicity and direct control it offers. Her friend Tom, however, opted for an S-Corp for his tech consulting firm, attracted by the tax benefits and the credibility it lends when dealing with corporate clients. While Sarah values the straightforwardness and flexibility of her LLC, Tom is willing to navigate the extra paperwork and regulations of an S-Corp to maximize his tax advantages and appeal to serious investors. How to make the right choice. Assessing the best structure. Think about what you want your business to achieve. Do you value simplicity and flexibility? An LLC might be your style. Are you looking to save on taxes and appeal to serious investors? An S-Corp could suit you better. Consider how much money your business will make and what's common in your industry. It's like deciding between a suit or casual wear based on the event you're attending. Just like you might ask a stylist what to wear for a big event, it's good to talk to a tax pro or legal advisor before deciding on your business structure. They're like your guide, helping you navigate through tricky decisions and avoid fashion faux pas in the business world. As we conclude our exploration of the dynamic realms of LLCs and S-Corps, it's clear that each business structure holds the key to distinct advantages tailored to your entrepreneurial journey. Making an informed decision can pave the way for not only tax savings, but also enhanced legal protections and operational flexibility. Now, it's your turn to engage in this dialogue. If you found value in our deep dive, we invite you to like this video, subscribe to our channel for more insightful content, and share it with fellow entrepreneurs. Your thoughts and questions enrich our community, so don't hesitate to drop a comment below. Let's continue to learn, grow, and navigate the business landscape together. Here's to making informed choices that propel your business forward.